Have you ever pondered what separates the truly wealthy from the average investor? What if the secret to amassing wealth wasn't just in numbers, algorithms, or market trends, but in timeless principles that have weathered economic storms and market volatilities? Enter the world of Warren Buffett, often christened the Oracle of Omaha. His name is synonymous with unparalleled financial acumen, yet his approach is disarmingly simple. Buffett's strategies, deeply rooted in fundamental truths, have not only turned him into a titan of investing, but have become the guiding star for countless beginners seeking to navigate the labyrinthine world of stocks, bonds, and assets. Are you intrigued? Excited? Ready for a transformative journey into the mind of a genius? So fasten your seatbelts and prepare your notebooks. Stay with me as we decode and deconstruct his 10 golden rules that could, if understood and applied, transform your investment game, turning dreams into tangible dividends. 1. Invest in what you know. A universe of stocks, but why does Buffett only pick a select few? Buffett's investing philosophy centers around simplicity and clarity. He profoundly believes that you should invest in industries and businesses that you understand, inside and out. For beginners, this translates into venturing into familiar territories. Instead of getting entangled in the complexities of an industry you're unfamiliar with, base your investment choices on what resonates with your knowledge and expertise. This doesn't mean confining yourself, but rather continually expanding your area of expertise. It's a powerful shield against market unpredictability. Investing in the known reduces risks associated with unforeseen industry-specific downturns. With a clear sight at where to place your bets, when's the right time to roll the dice. 2. The price is what you pay, value is what you get. At the bustling stock market bazaar, why does Buffett have a different lens to spot treasures? Buffett often distinguishes between a stock's market price and its intrinsic value. The former is what the market says it's worth, dictated by supply, demand, and market sentiment. The latter, however, is its inherent worth, often calculated based on fundamentals, business prospects, and economic factors. This perspective is essential. Just because a stock is expensive doesn't mean it's valuable. Similarly, a cheap stock isn't always a bargain. It's a balancing act of assessing worth and weighing it against price. For Buffett, the real treasures are stocks where the intrinsic value surpasses the market price. Recognizing the value is an art, but amidst this, how does one optimize profit? 3. Think long-term. In a world playing speedy games, why does Buffett play the long one? Warren Buffett is not in for the quick gains. He's here for the long haul. His investment strategy has always been about envisioning the future. Where will the company be in 10, 20, or even 30 years? By adopting this perspective, he shields himself from the emotional roller coaster tied to short-term market fluctuations. For beginners, this principle underscores the importance of patience. It's not about timing the market, but timing the market. Compounding, termed the eighth wonder of the world, works best when given time. And in that duration, while assets mature and grow, so does the investor's acumen. Long-term is the key, but how does one stay stoic during market tempests? 4. Be fearful when others are greedy. When everyone's at the feast, why does Buffett often retreat? The stock market, at times, can resemble a grand party with everyone scrambling for a piece of the action. But Buffett warns about the dangers of herd mentality. When investors are clamoring over a particular stock or sector, pushing its prices to dizzying heights is often driven by emotion rather than logic. During such euphoric times, Buffett exercises caution. He understands that inflated prices often lead to bubbles, and bubbles inevitably burst. For beginners, this is a lesson in restraint. It's about understanding that the market's mood doesn't always reflect reality. So, in the gloom of market downturns, what lights up Buffett's investment path? 5. Be greedy when others are fearful. When storms hit the market, why does Buffett often sail forth, undeterred? Contrary to the exuberance of bull markets, downturns are times of pessimism. But for Buffett, these moments present golden opportunities. He believes that market downturns, driven by fear, lead to assets being undervalued. And this is his chance to buy quality stocks at discounted prices. But this isn't reckless bravery, it's calculated audacity. He dives deep into fundamentals, ensuring that the company's inherent value remains intact despite the market's fearful sentiment. For novice investors, this principle emphasizes the importance of research, analysis, and above all, courage to go against the tide. Armed with insights, how does one then differentiate between a bargain and a trap? 6. It's far better to buy a wonderful company at a fair price. In the grand marketplace of stocks, why does Buffett rarely haggle for discounts? Warren Buffett's investing acumen goes beyond mere numbers. He values quality, especially when it comes to the companies he invests in. He'd rather buy a fantastic company at a reasonable price than a mediocre company at a cheap price. For him, the longevity and stability of a company play a pivotal role. Factors such as strong brand reputation, excellent corporate governance, and a consistent track record of profitability often overshadow short-term price tags. For budding investors, this principle serves as a beacon emphasizing the importance of long-term value over fleeting bargains. Because a quality company, even if purchased at a slightly higher price, is likely to yield consistent returns in the long run. Speaking of quality, how does one assess the hands steering the ship? 7. Invest in companies with strong management. Beyond financial statements and growth graphs, why does Buffett value the captains of a company? That company is more than its products or services. It's about the visionaries behind it, the leaders piloting its course. Buffett places immense trust in competent, ethical, and visionary leadership. The rationale is simple. Even a great business model can falter under weak leadership, while a robust management team can steer even a struggling business towards success. For Buffett, integrity, competence, and passion of a company's management are often predictors of its future trajectory. New investors should take a leaf out of his book and realize that investing in a company also means investing in its leadership. With stalwart leaders at the helm, what ensures a company's longevity in the marketplace? 8. Look for companies with a competitive moat. In the corporate battleground, why does Buffett favor fortresses over tents? Buffett loves businesses that have a sustainable competitive advantage, often referred to as a moat. This metaphorical moat serves as a protective barrier against competitors. It could be a strong brand identity, unique technology, exclusive patents, or even regulatory advantages. Such moats ensure that the company retains its market dominance and profitability in the long run. For those new to the investing realm, identifying companies with a clear competitive edge can be a game changer. These moats often shield companies from market volatilities, ensuring consistent returns and growth. While moats offer protection, how does one ensure they don't fall into the seductive traps of frequent trading? 9. Avoid excessive trading. The thrill of the trade can be intoxicating, but why does Buffett prefer the calm? For many, the stock market is akin to a high-paced casino, the allure of quick gains, the adrenaline of risks, but Buffett stands apart, advocating for calm and patience. He believes in the buy-and-hold strategy, where investments are made for the long haul. Frequent trading not only incurs transaction costs, but is also often driven by impulsive decisions rather than well-researched judgments. For novice investors, adopting this principle means resisting the temptation of short-term market movements and focusing on the bigger picture, allowing assets to mature and compound over time. As trades are minimized, how does one ensure they aren't swayed by the market's ever-buzzing grapevine? 10. Ignore market forecasts. In a world brimming with predictions and speculations, why does Buffett often wear earplugs? The financial world is never short of forecasts, predictions, and speculations. Every expert has a viewpoint, every channel a theory, but Buffett emphasizes the importance of self-reliance. While it's essential to stay informed, he believes investment decisions should be based on solid research and individual judgments rather than market noise. Past performances, company fundamentals, and personal investment goals hold more weight for him than speculative forecasts. For beginners, this principle is a lesson in discernment, teaching the value of personal research over herd mentality. With Buffett's golden rules unveiled, are you poised to pen your investment legacy? A journey from Omaha to Wall Street, peppered with wisdom, resilience, and unwavering principles. As the curtain falls on our deep dive into Warren Buffett's investment playbook, it becomes clear that true investment success isn't about mimicking actions but understanding and internalizing principles. These tenets, while simple, have the power to transform one's financial journey, turning every challenge into an opportunity, every setback into a lesson. And as you're about to step away, ponder this. If Buffett had an 11th rule, an even more profound secret, what would it be? If this exploration resonated with your financial aspirations, do hit that thumbs up, share your reflections, and subscribe for more insights into the world of investing. Until next time, as the Oracle of Omaha says, risk comes from not knowing what you're doing. Stay informed, stay wise, and carve your success story.